Welcome to EVNTAlpha, where I cover economic news and data, the S&P 500, and stock trading signals with captivating historical performances. After a major tech sell-off and a shift to risk-off assets due to a weak labor market print, investors are wondering what's next in store for us. Are we getting ready for another major move down, or was this just another buy-the-dip opportunity? With a ton of new information to cover, let's jump right into it. The first thing I want to talk about today is the major tech sell-off we experienced last week from Wednesday to Friday. Amidst a series of unpleasant earning releases across the AI and tech sector, investors' worries around AI spending only got worse. We had Google report a staggering increase in CapEx from $90 billion to $185 billion, essentially doubling their spending that occurred in 2025. Amazon reporting missed profit expectations and an AI and cloud CapEx guidance of $200 billion. And while Qualcomm beat expectations, their forward guidance was lighter than expected, highlighting some potential pressures on growth to counter the massive spending we are seeing across the sector. Now, many other big tech names experienced sell-offs such as Microsoft, PLTR, and others, not because of earnings, but because investors became increasingly uneasy about the continued heavy investment in AI infrastructure, toppled with slower anticipated near-term profits. If you have watched my prior videos, you know this is no new theme to the AI industry, and recent earnings that came out only proved those investors' concerns further. Taking a look at IGV, the expanded tech software ETF, you can really visually see how strong the sell-off has magnified over the last week amidst the hysteria, as it's dropped 33% all the way down to $80 a share since our peak in November. In addition to this ongoing theme of concern around AI spending, many have suggested that AI is going to disrupt traditional enterprise software companies. To elaborate a bit further on this, traditionally, software economics were built on code being expensive to write, engineers being the bottleneck, and features taking months or years to ship. Well, AI significantly disrupts this as code generation, debugging, and testing costs become essentially zero as development becomes more efficient and easy with AI. So while the supply of software explodes, pricing power erodes as that value held in the complexity of building the software is no longer there. More importantly, AI attacks the traditional subscription as a service business model as a traditional user interface layered over a database with rigid workflows can be easily replaced with natural language intent, eliminating the need for users to learn software. Now, ultimately, does this mean software will become obsolete? Absolutely not. It simply means the competitive edge is shifting from a well-designed user interface being the selling point to what proprietary data can AI leverage in your software that gives you that competitive edge. In other words, this isn't the end for software, but rather the winners will only be those who can adapt to this shift, protect their value added to consumers, and build products that are deeply embedded in regulated workflows. For this reason, we've seen companies like Adobe, who use the traditional subscription as a service model, suffer greatly in their stock price, as ultimately their selling point is efficient user interfaces that allow you to achieve your goals, such as Photoshop. And if you saw my video a couple weeks ago on Adobe, we did highlight this as a potential risk to the company. Now, the last time we saw a drop this severe in IGV in such a short time span was at the start of 2025, where we started seeing very much the same theme developing as we are now, in terms of concerns around AI spending and what AI means for traditional software companies using that subscription as a service model. Toppled with the implementation of tariffs on China in April, a major manufacturer of parts required for AI to work. Similarly to the 33% drop we recently saw, IGV experienced a 31% drop over roughly the same time frame last year. Now, why does that bring us to such an interesting spot? Well, for one, IGV recorded its lowest daily RSI reading in history, all while its current realized low is higher than the low of the prior correction. If you study technical analysis, this should be screaming to you bullish divergence, and I marked that with the orange trend lines as you can see. Also notice we have a confluence of support in RSI, with the support trend line in pink we've been developing since September of this year, along with that blue dashed line marking the two other lowest RSI readings we've seen since 2000. What does this imply from here? Well, ultimately, I suspect we see a relief rally back up to $88 to $89 a share, if not to $94 at our 38.2% retracement level, similar to what we experienced in May of last year. So keep an eye out for major constituents within IGV such as Microsoft, PLTR, and Oracle, along with IGV, as we could see some upward price action in the near future. For example, let's take a look at PLTR, in which you can see a similar setup in RSI with confluence and supports. Also notice price is currently at a prime support zone from $125 to $135 a share, in which if we continue to bounce off the zone, this could be great implications for retesting our pivot low at around $148 a share, if not past that. Taking another example, look at SNPS or Synopsys, another constituent of IGV, currently retesting a major support trend line that's been developing since July of 2021. We have an unfilled gap starting at $517 a share, so if we continue to bounce here, this implies a retest up to the start of that gap at least, and going on to fill that gap should we breach past that resistance zone from $517 to $535 a share. Also notice in pink the bullish divergence playing out at the moment, in which price lows are higher but RSI lows are lower. Not to mention also the favorable risk loss structure should your target be that resistance zone, as just 8% below, we have a major support zone from $377 to $390 a share. That will be difficult to break. With an expected gain of about 30%, that's a more than a 3-to-1 ratio between potential reward to risk, meaning if you were to play this risk loss structure over time, even if you were only right 25% of the time, you'd break even. To take it a step further, look at this backtest of SNPS when RSI breaches below 25 and crosses back above. We've seen 38 occurrences in the past 10 years, in which 95% of the time the price was higher, or 36 out of the 38 times, when looking 90 trading days out, or about 4.5 months from the trigger date. Over that 90 trading day duration, the price rose on average 18% and reacted at a profit factor of 22, meaning your wins were 22 times larger than your losses on average. If we were to continue to perform at this profit factor, even if you're right only 4% of the time, you'd break even. Taking a closer look at reactions, we have trading days out on the x-axis and cumulative percent change on the y-axis. In other words, what you're viewing here is SNPS's performance if you had bought it on each of the trigger dates and held for 5 months. In blue, we can see the average return climb up to that 17% on the 90th day. And in orange, we have our current active triggers, which there are currently 5 active ones, including our most recent. As you can see, recent triggers detected staggering moves in SNPS, some of them climbing as much as 30% in the first 3 months of the trade duration. Taking a look back at SNPS's chart on TradingView, that 17% average return would bring SNPS close to its 200-day MA at around $500 a share. Now, let's take a step back from IGV and focus on bigger picture as to what can affect the S&P as a whole. Well, to add more fuel to the fire of hysteria, we recently had a concerning increase in jobless claims of 22,000, and job openings sank to a post-pandemic low, suggesting the economy is barely adding any new jobs. Now, while there is no doubt the labor market is more fragile than at any time since the pandemic, this may not be as concerning as the reaction the market warranted. Thomas Simons, the chief U.S. economist at Jefferies, wrote in a note to clients, "I am bemused by how eager financial market participants are to jump on absolutely any sign of labor market weakness, no matter how small it is, or how unreliable the data series is." If you have participated in the stock market long enough, chances are you agree, as often the reaction in markets to bad news is an overreaction to the reality. This article by Jeffrey Bartash brings up good points on gaps in insight that are being filled by assumptions. Like, for example, the rise in jobless claims could be attributed to January's severe winter storms, where many people temporarily were unable to work and filed claims. The uptick in new jobless claims last week was largest in regions that were heavily affected by the snowstorm, such as the Northeast, but on the other hand, this could also be due to higher concentration of citizens in Northeast cities. While hiring slowed sharply last year after Trump introduced tariffs and reduced immigration, the economy has continued to grow at an above-average rate and corporate profits have risen, leading many economists to predict hiring trends will improve later in the year, especially if tariffs fade as a political issue, businesses gain more certainty, and the interest rate is reduced. Despite these scary headlines, the rate of layoffs is historically low and the unemployment rate is still below 5%, in which the U.S. has never had a recession without the jobless rate reaching 5%. Now, this isn't to say that increases we are seeing isn't an early indication of worse to come, but rather be patient and wait for more data to be released to see if this trend subsides, as should this trend continue, it could definitely be a very bad sign for the markets ahead. That further insight is just around the corner, as our unemployment rate is set to be released this Wednesday at 8:30 a.m. It is crucial that we see a print lower than 4.4%, as given what I've just elaborated on, investors in the Fed's concerns around the health of the labor market needs to be relieved. The market often panics under uncertainty, and strong sell-offs will ensue should we get a bad print in unemployment rate. Next Thursday, we have another report on initial jobless claims and continuing jobless claims. Again, to counter the current theme of hysteria around the economy developing, we need to see some relief in the data and printed jobless claims lower than the previous and consensus. In addition, we have our inflation rate coming out this Friday at 8:30 a.m. We want to see inflation continue to decline after the recent spike experienced from the implementation of new tariffs last year. This week of economic data releases is crucial, as notice where we currently are in the S&P. Last week we discussed if the S&P rejected at the top of our trend channel, we would go on to build further structure within this parallel channel, which is exactly what has begun to ensue. We also discussed what a break below the parallel channel could mean, in which we were likely to see a retest of the 50% retracement level. If you have seen my prior videos, you've likely heard many times that if we break below this 50% retracement level, we are likely undoing our move that started since the last week of November in 2025. We bounced off this zone between 38.2 and 50%, heavily suggesting it was just another buy the dip situation. And our most recent candle engulfed our prior two candles, suggesting that further upside is likely. With some of our most important economic data releases coming out this week, it is crucial to be paying attention, as it will likely dictate whether the situation gets uglier or if we recover back to all-time highs and continue to push further. Now, the last stock I want to talk about today is Zebra Technologies, or ticker ZBRA. They are a U.S. technology company that provides automatic identification and data capture hardware and software solutions aimed at digitizing and automating frontline workflows for enterprises. Its products and services help organizations track, monitor, and optimize operations in sectors such as retail, transportation and logistics, healthcare, and manufacturing. Now, this is one of those companies that comes to mind in which they could leverage proprietary data within their growing demand for AI solutions to gain an edge on software competitors. More specifically, in retail, supply chain, and healthcare sectors, AI could become increasingly stronger in the event proprietary data from real company operations can be implemented within their AI solutions. Imagine AI could determine trend levels of supply chain specific to that company based on the analysis of other clients or companies of similar size and industry, faster and at a much larger scale than any human could. That aspect of private data could become a serious competitive edge if they play their cards right, and of course operate in line with data privacy policies that their clients are comfortable with. Now on the screen I have my favorite strategy, mean reversion, in which it analyzes how far a price will deviate or separate from a moving average before it goes on to revert back to that average. It's a great strategy to catch market bottoms on extreme drops. Along with it, often triggers at price levels that are vastly cheaper than the intrinsic fair value of the company. Now, specifically for ZBRA, whenever it drops more than roughly 16% from its 200-day moving average, it rose on average 31% over the next 91 trading days, or roughly 4.5 months. When looking relative to the S&P, it outperformed the S&P about 9% on average, and when looking relative to the infotech sector, it performed in line with sector performance on average. We've seen 6 historical occurrences in which Zebra reached these discounted levels, and on all accounts the price was higher on that 91st trading day. We recently got a 7th trigger on February 5th, this past Thursday, in which it's currently up 4% from that point, and going on to trading day 2 on Monday. Taking a closer look at reactions, you can see the average return in blue climb up to 31% on the 91st day. In orange, we have our prior trigger on November 26th, in which you can see the price jumped about 9% the first 10 trading days and is now currently about break even. Maybe we see another jump this time around of similar stature. In terms of drawdown risk, we saw drops as much as 10% the first 5 trading days, suggesting you could potentially see a more favorable price than the trigger price initially before it goes on to perform well. Now, if I plot out that 31% average return, that gives us a target price of $316.50 a share leading into July of this year, and a downside risk of $216 a share, or 10%, to respect the 3-to-1 ratio rule. Now notice we are currently trading within 3 nested triangles in which lows and highs are gradually getting closer. Triangles are great technical patterns to use to identify the direction price is likely to go. Whichever direction price breaks outside the triangle is usually very strong and spurs further movement in that direction. So if you're a bull, you want to see prices start breaching that resistance zone created by the two smaller triangles and go on to test the top of our largest triangle. Should we break below the triangle base, we have a major support zone from 195 to 225, in which, based off price action the past 3 years, we're likely to see a bounce back above this zone if it reaches it. Should we start rejecting the support zone as resistance once that happens, this is a very bad sign and prices are likely to continue to drop past this zone. That is all for today. If you enjoyed, please give the video a like and subscribe. Good luck in the markets this week, and I hope to see you in the next video.